Right. Good morning, everyone. Welcome into another market talk with Cantonese Cat and Matt. How are you guys?
Doing great.
I was just enjoying the music. But yeah, doing great.
How are you
Very
guys holding
spooky,
up?
ominous. I'm holding
Yeah.
up okay. Just we've been scratching our heads about these altcoins, but everything else looks fine.
Crypto winter is coming. Crypto winter, get your straps on. No, sorry. Anyway, go ahead.
Right. Yeah. I mean, there has been a lot of volatility in the markets over the last couple of days, a lot of uncertainty going on. So we're here to clarify things. I think a lot of people are wondering what's going on with Bitcoin, with altcoins, because we got a lot of positive announcements over the last couple of days with the end of QT being announced by the Fed, a deal with China on tariffs. So why is crypto not pumping? What do you guys think?
I think it's trying to get us think, and it's trying to get us worried. It's trying to get us to doubt, and I think it's working. What do you think, Matt?
Yeah, it's working. I mean, it's really like I was just looking at it yesterday. Altcoins, if you look at the price from basically early of 2024, we're at the same levels. So it's really going to getting close to almost 2 years of just being flat. And this has really never happened before for altcoins. So, I mean, it's either going to happen or, it's just one of the biggest tricks ever. So we'll just have to find out. But I mean, I see the setup. It still looks like reaccumulation. I think things are good, but it's just going to take more time. And it's just going to wear people down, wear people down, wear people down. And yes, it's even wearing us down.
Yeah, I think it all starts really from the equity markets. So if we look here at the S&P 500, we can see that we're kind of repeating something we've seen from October of 2024 all the way to December and January of this year. And it's really, the start of a broader distribution phase in my view. So it kind of looks like we're having more and more volatility as we go up and higher, as we approach the cycle top. It's kind of what happened back here, right? Back from December all the way to January, we had a lot of volatility going on until we finally had the crash. But I think that this sets up for a more durable distribution phase, as in we're going to have more and more volatility as we near the cycle top. Because the reason why we have a lot of volatility, especially as we near cycle top formations, is because that's what allows market makers to easily distribute. Because by having a larger trading spread, they can, well, have more liquidity and they can distribute more easily by finding a counterparty. And I think that in the next couple of weeks and months, when we'll have more and more volatility in the equity markets, that will be the phase where liquidity starts to flow into other assets. And generally, in cycle top formations, we have very high risk appetite. And we're kind of seeing things setting up in this way, where positive narratives are starting to emerge already, with the Fed announcing their decision to step away from their quantitative tightening measures and essentially declaring their victory on inflation. And with the latest deal between US and China on tariffs, that's another positive narrative. And I think that it all sets up to a broader cycle top formation. And the main narrative we're going to see going on will be the soft landing narrative, where a lot of people will start to call for a soft landing because the labor market is still somewhat resilient. The personal income and personal spending are still somewhat strong. Inflation is cooling off, so we've seen it a couple of days ago at 3%, lower than expected. The Fed is stepping away from their quantitative tightening measures, so of course that will mean that more liquidity will get injected in the financial system. And it all sets up to this broader narrative around the soft landing. And I think that this will be the trigger that leads to the final rotation from the traditional assets to the risk assets. So I think that this volatility is not something to worry about unless we have durable structural invalidations, which so far we didn't have. I think that this remains just short-term volatility inside a high time frame reaccumulation phase that precedes continuation to the upside. What do you guys think?
I think that something's definitely happening. I think there's certainly a rotationary force going on behind the background. It does feel like we are making some pretty decent all-time highs in the markets, and with both large caps and small caps finally doing well in the overall market, and also international markets also doing extremely well. If you look at like Japan, it's just been going straight up. Um, gold has also been going straight up. So if you ask me whether or not there's enough liquidity to rotate into more risk on assets, my answer to you is I think so. Why hasn't it happened yet? Well, there's always the question is, why does it have to happen where you want it to happen? They're just going to be on their timeline, but it looks like the setup is there. That's what I think. So, Matt, anything?
Yeah, that's basically it. I mean, and it's just, when is it going to happen, right? When? The question is when. But every chart that I look at for at least like crypto altcoins, they're basically back at like 2024 early highs, so, or basically the same level. So it's just either they're building a long base to shoot up into space, or we're just going to have the biggest trick ever.
Yeah, I mean, here we also have the IWM. So over the last couple of months, the IWM hasn't done a whole lot, right? It's been essentially consolidating at the same levels as in this November and December of 2024. So not a lot has happened. But the fact that the price has broken above this high time frame resistance range is, in my opinion, a clear sign of strength. And generally, we can use the IWM as a way to gauge the overall risk appetite in the markets, because I think that as long as the price of the IWM stays above this high time frame resistance range and also above the 2-day bull market support band, which if we look here since early April when the broader markets bottomed out, it has been a very strong support point. So I think that as long as the price keeps holding above these, the most likely outcome remains further upside. Now, since we're in price discovery, we don't really have a lot of resistance above us. The only meaningful resistance levels that we can track are the 1.404 and the 1.618 Fibonacci POIs, which are currently much higher than current levels. And so if this risk on environment continues, and as long as the price of the IWM keeps consolidating above this high time frame resistance range, I think that the most likely outcome going forward is still further upside and for the price of the IWM to start targeting these upper Fibonacci extension levels.
Yeah, I mean, I think it's basically consolidating. It's a breakout and a back test, and back test going on a little bit too long for people's liking. And when people saying IWM is not doing anything, I'm just like looking at this, like, what are you talking about? It's been doing a lot since April. It just felt like it hasn't really done anything over the last month or so. But even if you look at the last month candle, it's actually green. So I think the market makers are doing a great job, kind of tricking the psychology of retail investors that are not really they're inconsistent with what you're seeing here in this chart, I guess I should say.
Yeah, I see that too. And like, actually, if you look at just monthly candles, there's basically for IWM, it's been doing nothing, but there's really like 6 green monthly candles in a row. So there's just a lot of, I think, momentum left in IWM. And especially, we just had our highest monthly candle close ever in history for IWM, which is really telling a story, in my opinion, that risk on should break out. Risk on should break out. That's what I'm seeing the most.
Yeah, and I mean, small caps going forward are really primed for growth, both from a technical perspective, as we can see here, as the price has broken above the high time frame resistance range, but also from fundamental perspective, because over the last couple of years, while we have been in a quantitative tightening environment, liquidity has been scarce, especially for these small caps. So small caps as an industry are very competitive. So they all compete for the same clients. They, even though they're in different industries, it's a very competitive whatever industry they're in, because they're small, they don't have really access to cheap credit. And so in order to attract new investors, because of the very high non-systemic risk that investors are exposed to by investing in these small caps, they need to keep a very high growth margin. And so in order to keep that very high growth, they need liquidity, they need financing. So over the last couple of years, they didn't have access to that financing because interest rates were so high. And they have instead diluted investors in order to keep the growth high, which is, of course, good for the fundamentals, but bad for the price action because the growth in fundamentals and operations is directly funded by investors. But now, since the Fed is announcing their decision to step away from quantitative tightening, we might see a rotation from the traditional assets within the S&P 500 to small caps. And generally, this is what happens in cycle top. This is the behavior we see, a rotation from the traditional assets, which, well, attract investors in the first place because of their strong fundamentals and stability. And then profits start getting taken from these traditional equities and rotated into something else that is, well, more volatile or more risky, but can bring more gains, because that's generally what happens in cycle top formations because of the very high risk appetite. And of course, you make a lot of profits, you secure part of them, which you keep on the sidelines, and then with, a smaller part of those profits, you start betting, right? Essentially, it's on the house, right? You no longer risk anything, just losing part of the profits you've already made. And that's kind of, I think, what we're going to see going forward. And this behavior will be fueled by the positive narratives going on around, as I've said, the end of quantitative tightening and soft landing, and all of these that really are intrinsically positive for the small caps, right? If you're looking at it, if you're thinking about investing in small caps and you haven't been through a whole lot of cycles, you don't have a lot of market experience, but you just look at the overall narratives and how they may affect the fundamentals, well, you look at them and it's great. I mean, who wouldn't want to buy a company that can only now expand their operations because more liquidity will get injected in the financial system? Who wouldn't want to do that? And that's what I think we're going to see going forward.
Yeah, I kind of agree. I see a lot of room. If you want to flip over to my charts here, I can kind of show you what I'm thinking. There are a few conflicting kind of points of view in terms of where money is going to rotate to, and I'm still trying to get a hang of it. But one thing I usually track on a pretty regular basis is the QQQ over SPY ratio. This is the monthly chart. So really, during a secular bull market, the Nasdaq should do better than the S&P 500 because even though it does have quality large cap companies, it's technically thought to be a little bit more tech heavy. And in general, you're going to have more risk on behavior. People are going to be wanting a little bit more exposure to the Nasdaq as opposed to S&P 500, which has more lackluster companies that are not necessarily growing, but they're doing okay. They give decent dividends, things like that. So I'm seeing a behavior where you have a rotation happening to SPY to the QQQ, because there's a lot of strengthening of the QQQ compared to S&P 500. That you can see here. You can see that the ratio is showing that there is a very bullishness thing that's happening here, where QQQ looks like it wants to kind of have a little bit of escape velocity against the S&P 500, because you can see the Bollinger Band's expanding on this ratio. And when you have the Bollinger Band expanding after a big giant squeeze like we did over here, it reminds me of what happened right here before this, the huge distribution phase that lasts for about 6 months to a year to get up to, the 2021, area. That could potentially last for, months, hard for me to say for sure. But when I see Bollinger Band squeeze because things haven't done anything, and the next thing you know, you start having expansion, it just seems like we might have a little bit more risk on behavior as QQQ, as an Nasdaq would continue to kind of outperform the traditional S&P 500. That's the first thing that I see. The second thing I saw really is just like what you're saying with IWM, on really have broken out. And I do wonder And I'm not saying that NVIDIA is going to be bearish necessarily, but I do wonder whether or not we're at the stage where we could have a little bit more rotation from large cap to small cap just based on the last 2 cycles alone. Because if you look at NVIDIA, whenever you have the Russell 2000, which represents the high, like you said, the high debt company and small cap stuff, whenever you have a breakout above a previous all-time high here, and you can see that during the last cycle and the cycle before that, when you have that true breakout with a very impulsive candle, that's when NVIDIA also does pretty decently, around the same time. But after that, over here, it's stalled for about 4 months while IBM continues to, make a bigger trajectory on the way up. It's more apparent on the last cycle around 2020, 2021, where IBM really had a big breakout here in November 2020. And guess what NVIDIA was doing in November 2020? Squat, nothing for how many months? 1, 2, 3, 4, 5. And even did nothing for 2 months before that. We might be at a very similar juncture where we have the breakout of the Russell 2000, and we did have a monthly candle close, about the previous high here. And NVIDIA did make a little bit of a higher high here, but I do wonder whether or not we have a little bit more rotationary force that are, kind of coming in terms of what we could be seeing. Now, on top of that, what is really hidden behind the scene, and nobody's really talking about this. I don't know why anybody, nobody cares when I post something like this. Engagement for the ARK fund, ARKK fund, is really at an all-time low. But the underlying stocks, such as Roku, such as Tesla, such as, even they have Palantir, they have Shopify, everything is looking pretty good technically, but nobody's really talking about it. It's really bizarre because it's been making higher highs and higher lows for about the last 2.5 years. And we just had a recent breakout of this channel over here, just 3-4 months ago. But nobody's really talking about this. People are still getting scared of Tesla. People are still getting scared of Coinbase. But when I'm looking at this actually primes a breakout into the distribution phase that could last for months, right? Because you're talking about a breakout of this channel pretty convincingly. And this current channel is a lot longer than the last cycle, actually. The same thing here with the accumulation phase on IWM on Russell 2000 was a lot longer this cycle compared to the last cycle. And the very fact that we have a breakout of the ARK fund and go up a lot higher, and people still not paying attention to that, a few months later usually is followed by IWM breakout. Here, same thing, right? Breakout of the ARK fund a few months later, followed by IWM breakout. A lot of these kind of distribution phases are showing pretty similarly. And it could last for months, and it can turn people's sentiment from being extremely cautious right now to more euphoria. When the large caps may be what people might be traditionally want to associate themselves with more, but the liquidity might actually be rotating to something else, higher risk, such as the ARK fund, such as IWM, and you might also end up seeing a lot of short squeezes with bad quality companies as distribution, just because they've accumulated and they want to distribute at high prices. It may not make sense fundamentally, I guess is what I'm trying to say. And it may not make sense for months when something like this kicks off, because if you look at IWM, well, not IWM, you look at the ARK fund technicals, actually look pretty good. You see that there's actually a bunch of expansion that's happening right now, just like you did over here, last cycle, and you can keep going up for a long time because there's no sign for really any exhaustion here at all that I can see, and it can go on for months. The other thing is too, if I pull up a Gantt chart here on the monthly, you can see how it's been following market symmetry here pretty decently. It's been riding up this angle here for a long time, broke out about this horizontal zone, and it just went to the next arc. Guess what happened? We just broke about an arc. Like, it looks like it wants to keep going higher. So I think there is a lot more rotationary forces. Now, I'm going to say one more thing, and I'm going to pass the mic on to you all. A lot of people have been euphoric when it comes to gold. And I think it's important to understand that there are a lot of liquidity forces that are in place that money can rotate into risk on. For example, the S&P 500, there's a lot of money can rotate over, right, to more speculative stuff. The NASDAQ, there's a lot of money that can rotate here to the risk on stuff, with small cap. Nikkei, the Japan market has been going parabolic. There's a lot of money potentially that can rotate, into more risk on assets. The Hang Seng Index has been making higher highs and higher lows for about 2 or 3 years. There's a lot of money that could rotate into more risk on assets here. And on top of all that, the giant animal of them all, gold. It's been kind of hitting my GAN resistance here, by the way. I think this actually gives pretty decent market symmetry, and it's been kind of hitting that. There are multiple things that makes me think that gold at least needs to take a break. And it's been going parabolic, and I think a lot of money could end up rotating over. It is actually at a parabolic phase where whenever we end up having an IWM or also 1000 breakout, gold tends to consolidate because of rotation. Same thing here, IWM breakout, gold consolidates here for a while. Same thing here, right? IWM is in, actually, this is like, from 2 weeks ago, we're already broken out. And then gold might consolidate here for a while. I'm not saying that gold crashes, but I'm just seeing a lot of potential rotationary forces here. If you're looking at the provide fib channel here, it looks like it's getting rejected here. If you look at the log scale, if you look at the linear scale, you can see that it's getting rejected here at 2.618. If you're looking at the regular Fibonacci levels on the log scale, it's getting rejected here at 2.272. If you look at the linear scale, it's getting rejected here at 3.618. There's a lot of confluence in terms of gold really kind of need to take a break. Can it go higher? Sure, it can. It's going parabolic. I'm not going to short it. I'm not going to say anything. But to me, I just feel like this is just big overall part of the rotationary pulse, if you will, and that's kind of what I'm seeing here. Matt, I'm going to pass it on to you.
Yeah. So in regards to all this rotation-y stuff, I think it's going to happen as well, but I don't think it's going to happen yet. Let me pull up my chart. And here's one example of why with IWM. If you use the fibs from 2018 to the COVID crash, guess what it's getting rejected at right there? It never touched it before, right? It never touched it before. So we're finally getting that point, which is 250.36. So if we're looking for like a full-on rotation out of other assets into more risk on, I think that level has to break first. And I think that's all it's waiting on. And for the past 3 weeks, we can just zoom in here. It's failed, right? It's failed to break above it. Like last week, the week before, and it was kind of like a bearish candle for last week. So is it going to do it next week? Maybe not, right? Maybe a little bit more consolidation. But I think if we're waiting on more risk on stuff to just explode, I think this level really has to break. And then like the next fib level is way up here into the 300s, which could become possible. But this is a level that never got touched in any previous cycle. So I think this is a very important level. So I've been watching that. And also in regards to your gold there, Kat, I have this fib right here from the 2020 top. Guess what it closed above? Just barely. The 3.618, 4,000.68. So that is maybe showing a monthly candle close could be proving that it's not wanting to go down any further. It could just want to consolidate a little bit and then decide what to do. So this could be another factor of trying to see which direction things want to go, right? It's not ready to break down yet. It really tried, like almost all day Friday. It was like flirting with that 4,000. Then it went down to like 3,900 something. And it did decide to close the whole month of October above that 4,000 mark. So that's an interesting development. So to me, IWM 250, it's got to break that. Gold has to break down from 4,000. So when those forces combine, then I think maybe a true rotation will happen. And maybe then our beloved altcoins could actually do something.
Yeah, I think it's all about having a trigger. I think that all the fundamentals are there, but we didn't have the trigger just yet because we need to have some sort of extreme narrative that really links everything in together. And until then, until we have it, we're starting to see signs of it, right? We're starting to see deals between US and China. We're starting to see the Fed stepping away from their quantitative tightening measures. We're starting to see, well, we've seen already the liquidity being printed by China and injecting their financial system, which of course at some point, which had an impact on gold already. And I think that at some point it will have an impact on Bitcoin as well. And we only need a trigger. The fundamentals are there, but we didn't have the trigger that, makes everything align and makes everything play out. Now, as a change of topics, we have here Bitcoin, which really has been inside the same high time frame accumulation range over the past couple of months. Nothing has really changed, right? As I said in one of my posts yesterday around the weekly market wrap up, I couldn't find anything other than, the range remains the same, the plan remains unchanged. It's pretty much that, and nothing has fundamentally changed. We have been consolidating around this high time frame resistance range. We've seen a lot of deviations above the prior all-time highs, followed by aggressive reversals to the downside, then deviations below this high time frame support range, aligning with the late May highs, and taps inside this high time frame support range, aligning with the November to December highs of 2024, and constant rejections and reclaims of the 2-day bull market support band, which has been a very strong reversal point. So aside from that, nothing has really changed. And in my view, the reason why we're seeing these constant liquidity sweeps, these constant traps, is because over-leveraged traders need to get out of the market before we can have any real directional move. So if we look at what happened back in early 2025, I know I make this point many times, and I have made it many times in the past, but I think that this is really one of the most important confluences we need to pay attention to. Because since Trump came in office and since the euphoria in January of this year, we really had a lot of liquidity traps which haven't been seen throughout this cycle so often. So throughout early 2025, we had these constant liquidity traps and series of untapped lows developing on the low time frames. And as I've said many times before, I think the main reason why we've seen these is because that's how market makers have managed to accumulate, and that's how market makers have managed to create an artificial counterparty. Because by setting up these series of untapped lows, this is where traders set their stop losses. And so if I would like to take a long position here, I would set my stop loss right at the nearest low, which in this case would be this one. And we had multiple of these series forming on the low time frames, and eventually we had some sort of tariff announcement that led to a liquidity crash and a sweep of the lows that of course triggered all of those stop losses, which are in essence a forced sell order, which is the perfect counterparty for market makers who are trying to accumulate. And because we've had them playing out over and over again, that's how I believe market makers have managed to accumulate. And then we had this reversal. Now, this reversal is essentially very interesting because here we didn't really have any sort of strong narrative. Yes, tariffs ended. There was a lot of excitement and a transition from that state of fear and anxiety we'll remember back in early April to a state of renewed optimism. And that was until late June, because in late June we had bad narratives reemerging once again with the geopolitical tensions between Israel and Iran. And that's when a lot of people panicked once again. But since then, we have been inside this high time frame accumulation range. Now, in my broader thesis around Bitcoin, because as we've discussed earlier in this market talk, we have all the fundamentals aligning. We have all the fundamentals there in order to get a full-on risk-on environment. Now we only need the trigger. But I think that market makers are currently setting up something far more interesting, which is an emotional gap, which is a thesis I've discussed in the past. I think that this emotional gap relates to a very rapid transition from a state of anxiety and fear to a state of full-blown euphoria. So what I'm thinking currently is, until we have that trigger we've discussed, this range is likely to continue. And as we can see, and as I'll also want to highlight on the on-chain data, we're seeing a lot of fear in the market. We're seeing a lot of people betting on a potential of a breakdown because they don't think that this is an actual reversal. They don't think that Bitcoin will go up from here. And the main reason why this happened is because this has been a time-based capitulation where the price does absolutely nothing. The market structure is still intact on the high time frames. We only have volatility. But in this environment of volatility and constant shakeouts and constant liquidity traps, where traders, by the way, are completely wrecked, you cannot trade this range because of the ongoing liquidity traps. Here we have a lot of bearish narratives that emerge, right? A lot of fears, a lot of uncertainty. And this, I believe, this whole thing that started back in early of this year will lead to an emotional gap. And this emotional gap will be a very rapid transition from a state of anxiety, from the current state of anxiety, to a state of full-blown euphoria once that trigger is finally pulled. Because think about this. People who are currently selling and increasing their cash exposure to, or even shorting to prepare themselves for a potential breakdown, what are they going to do if the price reverses very aggressively? What are they going to do once we start seeing new all-time highs and a rotation towards risk assets, while we have a lot of positive narratives that confirm the rally, right? Such as the end of quantitative tightening or the Fed, entering a quantitative easing environment, or more deals are going on, or the U.S. strategic reserve for Bitcoin. What are they going to do when all of those things play out? They're going to buy. They're going to FOMO in. And so that's essentially, in my view, how market makers will build the counterparty to distribute, because they're not thinking about this period. They're not thinking in the present. They're not doing a whole lot of in the present. They're not either accumulating, they're not distributing, but they're instead preparing for the next phase, which will be the distribution phase. We've seen the accumulation phase from January all the way to April. It took 4 months. Now, however, we'll have the distribution phase. In order to get a distribution, you need to have a very rapid transition from a state of anxiety to a state of euphoria, because that's what makes people emotional. That's what makes people appeal to all these kinds of emotional biases, such as the confirmation bias, which makes people appeal to all these sorts of narratives that confirm their own beliefs. And so after we have this big impulse to the upside, I think that's when things will start to get interesting. And I think that will represent the risk on environment, which we've covered in many of our prior collaborations. And that's how I view the upcoming cycle top formation. What do you guys think on this?
I think you're certainly setting up a case in terms of what should happen and what's not happening, and there's a gap. and I do think that nothing that changes sentiment quicker. So yeah, I completely agree with you. I think they're gonna come up with some kind of narrative, just like back in November 2020 during the last cycle, when you had the kind of like the exact flip of fear to euphoria, because the market did nothing from from August to October 2020, and all of a sudden in November things pumped. What was the narrative back then? It was COVID, and the narrative was vaccines. And did vaccines really end up changing lives for COVID? I mean, that's a debatable topic for another time, but there's going to be a narrative that's going to come, and it's going to justify the price action. But anyway, I kind of agree with you on that.
Yeah, and also just like hello, yeah, yeah, just like what we saw with the Bitcoin miners, their narrative shifted, right? It went from they're not miners anymore, they're AI, right? So that narrative shifted, and then they exploded. So we're just waiting for some kind of narrative shift, and once that happens, everybody will be on board. And I think that's just a matter of time. And it still is looking to me, especially for a lot of crypto, that it's just reaccumulation at these levels for a long time. And that means it's kind of like max fear. Usually bull markets don't end when it's max fear, right? So we usually end in euphoria, and that is not even close. Not even close.
Did you know that it's not really crypto, it's AI tokens? And did you also know that you can actually use AI to write smart contracts on Ethereum? No, actually, I don't know. But
You're a fundamentalist? What?
But yeah, I mean, like, they can just shift these things, and now they're AI dating centers. Like, there are a lot of dating going on, and I'm very happy to see that all these dating is really bringing into the price. But yeah, I mean, like, it makes sense in terms of the computing power. Like, an institution has been accumulating miners for a long time, and we just didn't really know what for. We see a divergence when it comes to miners and Bitcoin prices. Well, now you know why. Now you know why Iron is going up crazy. Now you know why Cyber is going up like crazy. they certainly seem to be decoupling with Bitcoin, and that might be why.
Yeah, and they're even breaking out a lot before IWM breaks out too. So, I mean, there's going to be a narrative shift with crypto too, and it's going to be too late then, right? Once that narrative shifts, it's going to be, you're going to miss like hundreds, maybe even thousands of percents of gains. So that's why we always like to accumulate at these high time frame support zones, which we've been in for a long time, a long time.
Yep. And a lot of people have been asking why AI HPC miners have been outperforming the traditional miners. And the reason lies in the hash price index, which tracks essentially how much money do miners actually make from their mining operations. And we can see here that it's currently sitting pretty much in an all-time low, which is also the reason why Cypher and Iran and other AI HPC miners have been massively outperforming the traditional miners like CleanSpark or Mara, because they have diversified their business model and they have migrated from traditional mining to AI HPC, which is far more efficient from a capex perspective. And those who miss the train, well, they miss the train. And I think that traditional Bitcoin mining is really inefficient right now because there are a lot of costs. So yeah, the hash price index is sitting close to an all-time low, and this is the reason why AI HPC miners have been massively outperformed. But also a point I want to make and a question I have for you guys is, what do you guys think on the 4-year cycle? Do you think that it's still playing out, or do you think that we could have something else this time around?
I mean, I never really thought that the 4-year cycle has to be fixed. The whole idea about the 4-year cycle was originally based on Bitcoin halving, I guess, because that happens every 4 years, and that was more based on the supply side. It's not really that important anymore if you're based on like a narrative perspective, right? Because sure, you're gonna have half of the Bitcoin, rewards and things like that, but most of Bitcoin's already in circulation, accumulate. It's already been being accumulated by institutions. So I think as time goes on, you're gonna have less and less impact of the halving. And then beyond that, I think that it just happens. Maybe IWM also just happened to have like these 4-year cycles over the last 2 or 3, and that's just kind of how liquidity cycle has been. So I actually don't know whether or not it is all because of halving, or is it just because of liquidity? I think liquidity is king. So as long as the Japan market, as long as the China market, as long as the IWM, the US small cap market remains bullish, I really don't see the 4-year cycle really playing out here. I just don't really see that. Matt?
Yeah, I've never been anything about time before, because people that always are absolute about time, they usually are wrong eventually, right? Because things are all about liquidity. Where's the money going? What's happening in the economy? And if there's a lot of massive growth happening due to AI and whatever, it could extend things massively. So I don't like to have time predict anything. I just follow price, and right now price looks fine.
Yeah, a strong correlation with the 4-year cycle has also been the relationship between equity markets and crypto. So, the S&P 500, the 4-year cycle for the S&P 500 has been playing out since the 1930s, right? And it has been very consistent, excepting with a few exceptions, of course. And I think that could be a very strong correlation. But do you guys think that Bitcoin and the broader crypto market could now perform more like a commodity rather than equities?
Probably not. I mean, I think it is still considered to be more or less speculative, which I still think that they are going to be where, during a little bit more of an exponential phase of global liquidity coming in. I think that they are still going to be more of a associated with risk on. On top of all that, just looking at the accumulation ranges, they've just been accumulated for about 3 years, and I just don't really think that they're going to behave. If you were talking about like commodities, whether or not it's going to behave like like precious metal, which have their own cycles, as well as other commodities in general, I just don't really see that. I think they're their own thing. And if anything, I think their liquidity is going to be tied more towards more risk on assets like the small caps in the U.S. And maybe even like international markets. The strange things is too, if you want to like kind of show my screen, I'm going to kind of share a few points here. The strange thing is too is if you talk about the 4-year cycle, I mean, a lot of people are referring back to this top over here, in 2021. They think that we're putting out the same thing because we have a little bit of exhaustive top so far. But the reality is this: like if you've put a fib channel on this last time, it was just simply just basically forming a little bit of double top over here. Here we're actually breaking above a fib channel level, and we're just basically back testing it. So there's not really much similarity here that I'm really truly seeing. The other thing too is like I really just want to say that this time really does seem different, because I've never really seen over the last 10 years when the Japanese market is going up, with a parabolic move like this, and Bitcoin does nothing. Like this really is the first time that I'm seeing this. So either Bitcoin, like you said, maybe decoupling it is becoming its own thing, maybe it's behaving like a commodity, or behaving like its own asset class or whatever. Or this is a bullish divergence that just simply hasn't happened yet. And there's a lot of liquidity that is still in the system that hasn't really been rotated into Bitcoin. Very similar maybe over here where you have a big run up here on the Nikkei on the Japan market, and Bitcoin does nothing until later. And these things can wait for, half a year or so. Even though more or less, I think these things should still be more or less correlated. Because I think I don't think in 2025 anybody's going to argue with me that Bitcoin is where increased liquidity tends to go to. I don't think anybody's going to question that. I don't think anybody's really going to be here to talk about like Bitcoin's dead or it's going to zero. I think the question is more like, why is Bitcoin doing nothing? Is this behaving as its own asset class? But as far as I'm concerned, I still think that that's where global liquidity is going into. The other difference here too from 2021 top, which is why I don't think the 4-year cycle is necessarily going to work out, is because if you look at Bitcoin compared to the Hang Seng Index, which is the broader Chinese market view, basically at this point, all the big Chinese companies are listed at the Hang Seng in Hong Kong. So this is a good way to look at Chinese liquidity as far as I'm concerned. And for the last 2 years, just been making higher highs and higher lows on the way up. And what you're seeing here during the last cycle was, during the big parabolic move phase up here, Chinese liquidity was going up. And as it was making a little bit of exhaustive top here in 2021, Chinese liquidity is already going down, right? So that was kind of a warning sign. There's a bearish divergence. I think that's the reason why the liquidity cycle. That's the reason why we end up having the end of the bull market in 2022, and we didn't really go much higher because of that. Here, we're not really seeing the same thing. If anything, Bitcoin's been doing nothing here for about a whole year, where the Hang Seng was just kind of keep going up. So I think that there is a lot of liquidity that hasn't really necessarily been tapped into yet. And it's just very different compared to what I'm seeing here on the last cycle. So I don't know whether or not I can really truly buy into the notion of, the whole 40 cycle thing. Same thing you look at over here, we basically have broke above the 1.272, and we are kind of trapped between the 1.414 and the 1.272. These two levels usually it could be reaccumulation based on looking at like across different assets and things like that. Like when I see things stuck between 1.272 and 1.414, but making a higher high and also back testing the previous breakout level, that to me seem more reaccumulation than it is distribution at this particular structure. So that's also another thing that is getting me to think that, hey, maybe that's not going to be a 4-year cycle kind of playing out. I don't know what Bitcoin is waiting for, but it certainly seems like it's waiting for something, and liquidity is there to go into it. It just hasn't happened yet, Luca. So I don't know. Matt, do you have anything to add to that?
Yeah, not really. It's just a waiting game for everything. And I think if you're waiting for a 4-year cycle to end, you might be doing yourself a disservice. So just let the charts tell the story right now. And right now they're not really showing they want to break down, but they're also not showing they want to break out yet. They're just stuck in a range. And actually, I do have charts that perfectly illustrate that with my linear scale for Bitcoin and Ethereum right here. Where it is. Yeah, so here's my Bitcoin chart. Look at the arcs, linear scale, right? For the past 3 weeks.
I'm seeing a black screen, dude.
You're not seeing it right now?
Yeah. Oh, there you go.
Okay. But yeah, it's just stuck in between the arcs for the past 3 weeks in a row. Well, actually, it's kind of been stuck for a while, right? Since it kind of broke down in August, it's been oscillating it back and forth, and with some false breakouts here and there. But this is proof it's just stuck in a range in between the arcs. And also Ethereum as well, right? We can see here, it's also stuck in between the arcs. Same exact situation where we see that the previous resistance right over here in December of 2024 is now flipping to a support right here, but it's also stuck in between these two arcs for the past 3 weeks in a row. So it is waiting for something, but it's not breaking down, but it's also not breaking out. So I just think we cannot just say, okay, 4-year cycle's coming to an end, so it's over, right? Well, the charts are not really saying that because it's not breaking down. It just needs more time, more time. And I just think that it's probably going to happen because this still looks like a very interesting previous resistance zone, right? We can just literally draw a line and switch to monthly candles here. And voila, right? You can go to the bodies of these candles right here and just eliminate the GAN and just see, look at that. It's a previous resistance zone flipping to a support. That's not breaking down. So I cannot agree with any kind of a 4-year cycle because it just looks like it needs more time. And more time means maybe a bigger explosion is coming.
Yep, I do agree with that. And but I'm sure a lot of people would also want to hear what would be the invalidations for you guys that you would track going forward.
For me personally, I think just a loss of momentum really on the higher time frame, and specifically when you look at like just the Ichimoku cloud, if it ever started to like flip things to resistance down here, but we still have, as what Kat would say, a katana forming down there for Ethereum, the conversion on the baseline of the same price, and even for Bitcoin as well, we can go just check that out. And the monthly candles did not even touch that conversion line yet. So, I mean, at least a breakdown, because we can use our monthly conversion line as a trend indicator, right? It hasn't closed below that ever since it broke out in 2023. It's been closing month over month over month over month over month above it. There was one period where it did open below it, but it closed above it. But I think that would be at least a beginning factor of maybe being concerned. And that's right now at 100,000. So if it ever started to close monthly candles under 100,000, then be like, okay, maybe things are slowing down. Maybe it's time to just go lower. But so far, we haven't seen any sign of a loss of high time frame momentum. So that would be the first thing that I would look for, just using monthly Ichimoku clouds to see how price is reacting with the trend. And this blue line is our trend. And the trend is our friend until it's not. And so far, it has not even touched it in the past couple of months. Even with that October 10th scare, did not even touch it. So I don't have any concerns at the moment. Kat?
I don't have a lot of like charts to show my invalidation. I'm just going to say a few things. So if global liquidity goes down, that could be an invalidation. I'm seeing no sign of it. I just showed you. Even gold is, looking like there is an increase in liquidity just pulling into the system. So there are no signs of it. If IWM, the Russell 2000 makes a lower high, I'll be more worried, right? And then on top of that, if I have a hard time finding Palantiring stocks, I think that would be invalidation. I'm still finding Palantiring stocks all the time. There is liquidity still pouring in the system, and they want to flood into various stocks that have good foundation. And then finally, if Bitcoin dominance goes to 100%, that would be invalidating no, I'm just kidding. Anyway, but I think that everything ties into liquidity. I'm not seeing signs of things breaking down. Thus, I'm still going to remain bullish on risk-on assets.
Exactly. Luca,
Yeah, I also have here a chart I want to share. So my current invalidation scenario would be for the price of Bitcoin to close below, on a weekly close, below $103,000, which aligns with this high time frame support range, aligning with the November to December highs of 2024. If the price were to close below that with a weekly candle, that would be a warning sign that, okay, things might be starting to break down. And in that case, because I'm sure a lot of people would like to hear what my practical solution would be, this is also the reason why I emphasize the importance of having a moderate allocation to cash, and also to maintain a somewhat diversified portfolio across multiple industries and defensive sectors, because that is what really allows you to adapt yourself. So in case we would see a weekly close below the high time frame support range, marked in green, in that case, I will look to hedge part of my spot holdings in order to mitigate the short-term downside risk by taking offsetting short positions to my spot holdings. And so that would be sort of how I would adapt myself. And in case of a more durable breakdown, as in this is not just a brief deviation, but a durable high time frame shift in the trend, like something like this with a durable rejection here, taking it as a resistance and then continuing to go down. In that case, I would look to hedge all of my spot holdings, and then once some sort of high time frame support range starts getting tapped into, like this one at $93,000, I would start to rotate out of the defensive sectors and defensive positions I have in order to once again increase the exposure I have to Bitcoin and to risk once the risk reward setup has finally returned in favor of buyers and bulls. So that would be sort of how I would see my invalidation scenario playing out. And going forward, because we're essentially in uncharted territories regarding the seasonality, the cycles, the price action, the correlation between the stock market and the commodities with the broader crypto market, I think that the best approach to both enjoy the optionality of upside and to have the safety net that you need is to keep a moderate allocation to cash. 6 to 7% of your portfolio should be into cash, in my view. And also to have allocations to defensive sectors and to multiple industries like, AI, miners, consumer discretionary, and whatever you want to be invested into and fits your personal goals and personal risk appetite and risk profile, in order to have something to scale out of if the markets turn against you with the crypto market. So that's how I view investing, because what a lot of people do is, unfortunately, they look at some of our collaborations, we highlight all of these bullish fundamentals, but behind the scenes, we are not fully overexposed to crypto. We have other investments. And so I don't think that if you're bullish on something, you should be overexposed to that or to be over leveraged, because those are two completely different things. Being bullish on fundamentals that may take weeks or months to play out, to being over leveraged on an asset, because nobody can really predict what the next low time frame move will be. Maybe we have this playing out and $92,000 gets tested before there is a more durable reversal to the upside. Well, in that case, those who are over leveraged are going to get absolutely squeezed. And so that's why I always emphasize the importance of avoiding leverage. I think that's a very smart decision you can do with your portfolio, and to maintain a diversified portfolio. So that would be, in practical terms, what my recommendation would be. And of course, it's not financial advice, but based on my years in the markets, that's, in my view, how the best approach of an investor should be. What do you guys think?
Before I share my thoughts, I kind of want to know what you think about cash, because I think you probably have some thoughts on like the repo market and things like that. I do have a couple other thoughts, but I want to hear your thoughts on that first.
Well, sure. So here we have the latest spike in the repo market, and it's the highest we've seen in over 5 years, but doesn't even compare to what we've seen back in 2020. So in my view, it can be interpreted in two ways. The first one is that the Fed is trying to fix some underlying issues within the financial system. So they're starting to print liquidity and buy, because that's generally the whole purpose of these overnight repurchase agreements, to stimulate the liquidity in order to avoid cracks in the financial system and banking system. Or this is their uh, this is their way to show that they're done with quantitative tightening, and that now they're starting to once again slowly and gradually transition towards a quantitative easing environment. But so far, I don't think that this should be considered a warning sign. Some people may do consider it a warning sign, but as I've said before, it's nowhere near the levels it has been back in 2020, when the Fed was aggressively trying to stimulate the liquidity by buying a lot of treasuries. So I think that it could be bullish actually for the markets, because there's more liquidity that is being injected in the financial system with the spike. And unless we start seeing other cracks within the financial system, like the labor market starting to weaken, or personal income, personal spending going down, or the PMIs going down, I think this is not something to worry about.
And Luca, and also, can you help explain like the U.S. M2 money supply versus the repo market? Can you explain this for the market participants? Because the M2 has just been going straight up, whereas this is like a newer finding. Just kind of wanted to hear your thoughts on that.
Well, yeah, I mean, the global, so the M2 for the US is the total amount of money that is accessible for consumers, essentially, and within the broader financial system, because there have been some changes to it and so forth. While the overnight repurchase agreement is essentially how the Fed is collaborating with the commercial banks in order to maintain the liquidity in the financial system somewhat stable, because there are a lot of um, confluences that are aligned with this, as in we have interest rates between commercial banks, we have interest rates between the Fed and the commercial banks, we have credit spreads, and we have the high yield spread, we have the investment grade spread. And in order to avoid any sort of cracks or major spikes that would later on have a ripple effect across the whole financial system, this overnight repurchase agreement has been created in order to maintain the liquidity within the financial system somewhat stable. So when we're referring to the M2, it's pretty much the total amount of money as a whole. And when we refer to this repo agreement and facility, it's essentially how the Fed manages to keep the liquidity within the banking system stable and avoid any sort of cracks.
Yeah, so with a combination of, and I'll tell you kind of, what my thoughts are in terms of allocation, things like that. I'll never tell people what to do. I'm just kind of sharing, in terms of what I'm thinking. The M2 money supply has been going, up. And Matt, if you want to just kind of flip over to me real quick here. This is the US M2 money supply. You can see what they've been doing is that the supply actually did go down, just like you would expect from quantitative tightening. But the interesting thing is that you actually have the bottom of the US money supply right around October 2023. What also happened around October 2023 was a few pretty significant things. First of all, that was when the 2-year yield had topped in October 2023. It looks like it's in a big distribution pattern here. That's also when the 10-year yield had also topped. And on top of all of that, that's also when the IWM had bottomed this cycle. So I do think that the money printing is going on has already started. I think they're just basically trying to allocate the money into different ways to make liquidity more available to the system. And that, to me, I think is a pretty strong indicator that risk on is happening, rather than them trying to put away, try and put away any fires, because like we're not really hearing any banking failures right now. Why did banks fail? Well, it's because bonds exploded. A lot of and you were talking about like bonds like TLT, and I just wanted to like I don't want to like get too distracting here, but you talk about bonds like TLT. It's been doing extremely well, and it's been forming a bubble for forever. It hasn't really had any deleveraging, and you actually have banks that ended up, just leveraging bonds like crazy and thinking that things are just always going to be great. They got deleveraged, and that's exactly what happened back in 2023 when a few banks have failed, is because of that. They got caught offsides. Right now, you're talking about deleveraging of the market of IWM for many years. You're talking about the QQQ have already been deleveraged in 2022, as well as in 2025 just now. You're talking about deleveraging of the, of like ARK Fund. You're talking about a lot of deleveraging that has already happened, right? I mean, I can even argue like gold has capitulated sideways over here for about 2 or 3 years, which is why it's been going up a lot higher. And you're also talking about the recent capitulation that happened with crypto here as well, where we just capitulated sideways and down. All of these things are, are deleveraged. And as far as I'm concerned, I don't really see any reason for any like banks to necessarily fail, because I don't really see the crazy over leverage like we did before. You can argue that, yeah, they're over leveraging, stocks and whatnot, sure, but there's enough liquidity, there are enough signs that liquidity is coming in to kind of help support them, right? Just look at the fact that the US M2 money supply is going up, looking at the fact that they're also putting money into the repo market. So to me, I don't really want to hold a big cash position. I want to hold a cash-like position in a position of strength in the stock market, like Palantir. I think that Palantir is, to me, at this point, equivalent to a cash position. If you are looking at to strength, I think that a position like Tesla is equivalent to a cash position, because it's been benefiting from liquidity going in. It's been forming higher highs and higher lows. So to me, I think it's important to diversify. I do have a hedge, which is I do have an income, which is my job. That is where I'm going to get cash coming in. If I did not have an income, I think I would be a lot more conservative. But because I have an income, I am going to position myself in a position of strength, rather than, just constantly worry about the market, having downturns, because that's my hedge. And that's kind of how I view the market based on my own situation. So, Matt, any thoughts?
Yeah, the whole idea of like cash is king. I think it's good to raise cash at important resistance levels. It's not good to accumulate cash when it's just basically at really high time frame support levels. And same thing, like if you have an income, you basically can be more risky. If you don't have an income, then yeah, be a little bit more conservative. But the idea of cash is king, I think, with the invisible tax every year due to inflation and just the debasement of currency, I think you are doing yourself a disservice by just raising cash, especially when prices are just consolidating for such a long time, getting ready to go higher. So I don't view cash as that important right now, as not as important as it used to be, because it's just the invisible tax to year after year after year.
Actually said something very interesting around the deleveraging in the financial system. And I also think it may have something to do with the yen carry trade and Japan transitioning towards a normal inflationary environment and normal monetary policies. So what do you guys think on Japan, if you have any thoughts on it?
I mean, the Nikkei has been shooting straight up here. I can tell you exactly what I think about the Japanese market by just showing a chart right here. That's a pretty straightforward thing here. I don't even need to know any like fundamentals or anything like that. There are two Dragonfly monthly candles, number 1 and number 2. like basically, like you're talking about two things that happen based on narrative, and that like nothing burger has came out of it. This is the first Japanese yen carry trade that everybody was all scared about. Turned out to be a nothing burger, because the financial system is running by liquidity, and because all these governments probably work together, and because you need a deleveraging event to really scare everybody out. Then they decided that they want to go for a second deleveraging event right around the tariff scare, and that also caused another dragonfly candle. Like these things are extremely bullish. When I saw these things, this dragonfly candle basically just backtested the 20-month moving average. This dragonfly candle just basically touched the low Bollinger Band. And the entire time, the Nikkei, the Japanese market has done nothing for close to 20 months. Bollinger Band is squeezing. Guess what's going to happen? You have deleveraging. It's going to go up. I don't mean to be like deterministic about this, but like this technically is just. I don't even really need to know much about like the fundamentals, because the fundamental is that the market has been deleveraged and is ready to go up. And if you ask me about like, crypto and the broader market, I think crypto just had a great deleveraging event that just happened a few weeks ago. I've shut up about that. So, all right, Matt, any thoughts?
I think back when we did the Triumvirate shows a long time ago with Tracker, I showed this chart of my GAN Nikkei right here, and how it was a previous resistance flipping to support multiple times. And the first time I think we talked about it was right here in August of 2024, how it did that backtest. But like you said, these double backtest V bottoms were just a perfect setup for getting the liquidity needed to go higher. And now the Nikkei, it looks like it has plenty of room to even go up to the arcs above, which could be in the 70,000, 68, 66, depending on time, right? It looks like it's set up to go there. So there's no concern, even though it's looking kind of extended. Yes, there could be some pullbacks along the way. Nothing goes straight up in a line, but to have fear, especially at this symmetrical support, which was a 1990 resistance, that just didn't make any sense to me, because it was finally breaking out. It was finally, after all that time, decades and decades of never breaking that level, finally did it. So there was no reason to have fear during those deleveraging events. It just looks set up perfectly. And actually, I think kind of what we're seeing with a lot of crypto right now, they're flipping previous levels to support too from the past, and it's kind of similar how they keep getting liquidity below levels too. So it could be the perfect scenario for what is to come for crypto, in my opinion.
Talking about crypto here, I want to share a chart on Ethereum, because a lot of people have been really anxious on Ethereum over the last couple of weeks, but nothing has really changed. So we can see that the price of Ethereum is holding strong above the high time frame support range, which has previously been a strong reversal point throughout 2024. It has been a resistance here back in March and back in June, as well as back in December of 2024. It also has been a resistance here back in July. And this range also aligns with the weekly bull market support band, which has been a pretty strong reversal point here back in May and back in late June. So for this reason, I think that purely from a structural perspective, nothing has really changed for Ethereum, as is the case for Bitcoin. The market structure on the high time frames remains largely unchanged. And so now this is just short-term volatility we're talking about, whether we could see another rejection here, this golden pocket between the 0.5 and 0.618 Fibonacci POIs, like we've seen the last time it got tested, or whether the price will break through it like this and start testing and targeting the high time frame resistance range, lining with the all-time highs. So I think that Ethereum, purely from a structural perspective, looks really good. And if we compare it to other altcoins, it looks much better. So I remain bullish on Ethereum. I think that Ethereum going forward is likely to outperform Bitcoin as we move deeper in this current risk on environment. They're also closer to the cycle top. And these are my thoughts on Ethereum. What do you guys think?
Yeah, Matt, if you want to flip over to my Ethereum chart here real quick. The thought remains very similar across various assets. I just showed you that bonds were greatly deleveraged. I just showed you, that Russell 2000 had greatly been deleveraged, and that's why we have 6 months of green. And Ethereum has been greatly deleveraged. I think a lot of people, number one, kind of forgot that we had a deleveraging event of Ethereum that went all the way down to the 1400s or 1300s. That just happened about like 6-7 months ago. But people have selected memory. They remember that, and they think we're going to go back down there again when we already had a lot of deleveraging that had happened. If I look at the way that each cycle has progressed, you have really, and it kind of makes sense, just think about, and this is kind of how I think about fundamentals, and I don't really necessarily follow every single narrative, and I follow where liquidity flows are, and also follow whether or not certain assets have had a controlled liquidity grab or controlled deleveraging, if you will. And Ethereum has shown us over cycles after cycles that it does the same thing over and over again, where you initially have an increase in demand with Ethereum here, as you can see with a trend line here, there is increased demand, and certainly have been increased demand here for Ethereum really ever since mid 2022, after it deleveraged greatly, right? There has been increased demand behind the scene here, but there's still a lot of supply up above because people are scared, and because liquidity is going to other assets, and it's not rotated into Ethereum yet. But we just had a great deleveraging event where it broke down underneath that trend line and got everybody all scared. It was one of those events that Ethereum was supposed to be dead. With that, that's why you have a very powerful V-shaped recovery, because the overall structure is bullish, but you have a breakdown. This is actually something that is bullish to me. And you end up having, sure enough, basically a little bit of a back test here, and you end up breaking through above. This is also another extremely bullish thing. Like, it didn't die, and it came back alive, and it claimed previous resistance back in the support. And now it's also, with that energy, it's also pushed through another resistance level up here that's been going on for really ever since like 2021. And it's being back tested right now as we speak for about 3 months. And to me, this is a very bullish event, right? Because the same thing happened last cycle. You had that COVID deleveraging event that got everybody all scared. Things just happen a lot quicker previous cycles, right? Here, the accumulation range ended up happening for about 2 years, and then and then just breaking above. Here, you're talking about like 4 or 5 years of accumulation range. Here, you're talking about maybe like reaccumulation here for about a whole year, right? So I think this liquidity cycle for Ethereum seems to be running longer, but the structure remains the same, and the idea remains the same. And I don't really think that these deleveraging events should be taken lightly, and I don't think that they necessarily have to be repeated. Because this is how market makers kind of throw you off sides. Those are kind of my thoughts. Matt, you're up.
All right, let's take a look at my Ethereum log scale Gann chart here, and I'm going to make some comparisons to the others chart. So we had the bottom already in for Ethereum. You can see my screen. Yeah, okay. Right here, right? It hit the bottom arc, which coincided with actually the 2018 previous top as well. So we got that liquidation event needed to break this arc finally for reals. And now, once it broke, we're basically doing something where it did last time, right? Once it broke the arc, it just melted up to the next level up here, and then it stalled out, bear market, and then it took a long time. A long time to break this top arc. And finally, there was like some false breakouts here, but that's because it probably needed more liquidity and liquidate all those leverage positions before going higher. And now we're finally breaking that out. And also, this is a previous resistance levels flipping to support that I showed before. So price is likely to gravitate to at least 8,000, right? 8,200. And also, when we put on some fibs, really from the same cycle of the 2018 that I was talking about right here, right? This is the 2018 top and the 2018 bottom. Guess what that fib is? It's the 1.414, which was the cycle top back in November 2021. So it's just not ready to break that yet, and that's 46.49. So is it going to go back down to this like $3,000 level again and retest it? I mean, it's already done that so many times. I don't think it's really that necessary to go back down there, especially after already back in March and April retesting the 2018 top as well. I don't think it's really that necessary. And guess what? The 1.618, it coincides with that green Gann level as well. So I think that is going to be the likely target at a minimum. I think that's probably where Ethereum is going at a minimum. I mean, could it go up to the 54,000? Who knows, right? 40,000. That's something that we can talk about at a later day if this 1.618 ever breaks. But what I'm seeing with this one is actually very similar to what's happening to the others chart, right? You can see this arc, once it broke, we saw a continuation higher. And so my others GAN chart here, we can see it's very similar, right? We had a back test already about the 2018 high. I mean, Ethereum did it in March again, right? The 2018 high. Does that mean others need one more back test of the blue level here at 70 billion? That would be very, very painful. I don't know if that's necessary because there's just more and more altcoins being added to this others market cap. So it's probably going to keep it afloat a little bit. But the same thing's happening, right? This arc is acting as a resistance just like Ethereum did. And so once it breaks, it's going to go. And where's the next level up here? Well, that's at 3.7 trillion. That seems not reasonable right now because it's only 252 billion. So it's like, that's insane, Matt. How big of a percentage would that be? That's basically 1,400% increase. That would be pretty massive, but it's very similar to Ethereum. And also, I did talk about this last time us three got together, how back in COVID, the bottom arc got rejected and we had that flush during COVID, and that was required for the breakout of this arc as well to go higher. So I'm seeing a lot of similarities from others to Ethereum. I think what we're going to see is more patience. I mean, maybe, just maybe, we need to get closer to this 45-degree angle like we did back in 2016, right? We just got closer and closer, almost even touched it and go higher. So if it needs more time, what is that going to be? In January, February 2026, maybe March, right? If it just stays around the same levels, April, May, and then it hits. I mean, this could be another 6 months of just painful consolidation, perhaps just waiting for time to pass to get to this previous resistance zone that we see way back here. Resistance, 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 breakout, never really back tested it. So maybe it needs another 6 months of just annoying and pissing people off before going higher. Who knows? Maybe even 8 months. We don't even know. But it's a very similar setup to Ethereum. And I think since Ethereum did it, I think the altcoins can do it too. But once it breaks, I don't think I would want to be short or bearish on it because this could easily be a 3 trillion market cap just for the others, which is excluding the top 10, right? So still very bullish, but it's just a time thing. In my opinion, it's a when, not an if situation.
Yep, I agree. And I also have some thoughts here on the on-chain data I want to show. So while the price has been going higher over the last couple of days for Bitcoin, the open interest has been going lower. Now, the open interest shows us the total amount of perpetual positions, so both longs as well as shorts. Now, essentially, whenever the open interest is going lower, it suggests that there are fewer perpetual positions. But the open interest in itself doesn't tell us whether those positions are longs or shorts. So here is where funding rates come into play, because funding rates tell us the ratio between longs and shorts. And we see that the funding rates have been forming higher highs, suggesting that there are more longs. But because the open interest is going lower, it suggests there are fewer perpetual positions. What's actually going on? Well, it suggests that there are fewer short positions because they're getting squeezed. Now, to add another confluence, we see that while the price was going lower here, the open interest was going higher, while funding rates were actually going lower, suggesting that bears were doubling down on their short positions, betting on the potential of a more durable breakdown. So what does this tell us? Because this doesn't really tell us much. Okay, shorts are getting squeezed, shorts piled in while the price was going down. What does this mean? Well, I think it's a very clear representation of the current market sentiment, which is that people are trying to bet on the potential of a breakdown, and that people do not think anymore that we could have a more durable reversal going forward, which is, in my opinion, a very bullish thing. To be on the other boat rather than the majority has, from a historical standpoint, been the best decision. So yeah, that's what I want to highlight. And with the fear and greed index, we can all look at with the X sentiment and the posts that are going on there, with a lot of people quitting crypto because they are being frustrated by the performance of meme coins and altcoins and so forth. It's a really nice addition to have the on-chain data here.
Yeah, it's always good to know what the sentiment's doing. What do you think? Like we're not that big of accounts really on X or on YouTube. I really don't think that we're that like influential. And I keep seeing posts say, oh, people are still being too bullish on Bitcoin, still being too bullish on Ethereum. Oh, it has to go down lower. Like the reality is, I think I see a lot of big accounts that are like 10 times, 20 times bigger than us are really like capitulating and are really just kind of giving up. So I don't know what to make of it, but I think this kind of illustrates what I'm seeing rather than what people are thinking, which there's some divergence there too.
Well, it's really interesting you said that, because I think that those accounts don't necessarily operate based on their own personal sentiment like we do, and on how we interpret the markets based on the conferences we've looked at. They instead work mostly like the mainstream media does, right? The mainstream media makes their money from engagement and clicks. So each time there is any sort of market movement, they have to justify that by having a narrative, right? So let's take an example, right? We have rate cuts. Well, you can present rate cuts from two completely different standpoints. You can say that rate cuts are bearish because they signal Fed's intervention and desire to change the trajectory of the economy because there's some sort of underlying issue going on that the Fed is trying to solve. Or the mainstream media can present rate cuts as something positive because it signals that more liquidity will be injected in the financial system, and cheaper credit and cheaper financing gives access to companies to further expand their operations. So you can take the same objective information and present it in two completely different ways. And I think that that's the way mainstream media operates in order to drive the most engagement and clicks, by appealing to how most are feeling. And that's the same way these very big accounts also operate. So they're not trying to create intrinsic value, but they are just trying to create engagement. And the way you create engagement is by always being on the boat with the most people, right? When the prices are going down, you're going to present something bearish. When the prices are going up, you're going to say something bullish. So it's pretty simple. And I would mostly use these big accounts as a confirmation for the market sentiment, not for the market sentiment itself. If these big accounts are posting something bearish, is because most people are feeling bearish and they're trying to capitalize on it.
Yeah, Matt, what do you see so far? Do you agree with what we're talking about?
I mean, yeah, I agree that a lot of big accounts basically they just go with the flow, right? If people are bearish, they're going to just pile on and be bearish. People are bullish, they're going to pile on and be bullish. So it's just they follow the herd. It's especially a lot of fear out there gets more engagement too, because people want to agree with that for confirmation bias, because they see things are not moving up. So the only logical conclusion is they're going to have to move down. But really, that's not really that logical, because levels are not even breaking, even though they keep on retesting support and they keep on making higher lows and higher lows. So I don't know. The sentiment is an interesting thing out there, and people just they get too emotional. So I'm in the camp of just let the charts prove what they want to do, and so far they're just stuck. And being stuck is not bearish. It's not exactly 100% bullish either, but it's just neutral. Just wait and see.
Are you getting a bunch of hate right now still, Matt?
Only for MicroStrategy, or sorry, strategy. Only for strategy, because everybody's like swearing it's going down to 150 now. That's going down to 0. Who knows where it's going? But I think what people don't realize is MicroStrategy had a huge run already, so it's understandable to cool off for a while.
That's all fair.
Yeah.
Luca, do you want to move on to anything else, or anything else pique your interest?
I mean, as a final thought, what's your plan going forward? Because I'm sure a lot of people who are currently watching this would like to know, okay, so what are you going to do next in the next couple of days, in the next couple of weeks, in the next couple of months? What should we focus on? And, because there are over 10,000 people watching live, so pretty amazing.
Yeah, my thought is this, and I'm going to be a little bit more Godfather about it. I'm going to do this. Nothing. not trading in and out, not playing options, not doing over leveraging. I'm going to continue the dollar cost average into some things that are showing strength and some things that are showing short-term weakness. I'm going to keep on doing my strategy, and I'm going to do nothing. Those are my thoughts. Matt?
Yeah, same. I'm not going to panic, and I think panicking is never a strategy, especially when support levels are holding. We should be more cautious at higher time frame resistance zones instead of being more euphoric, right? I think do the opposite of what you feel is really the key, because when people are like, "Oh, things are so great, it's just going to keep exploding," and well, that's really resistance, guys. Be a little bit more cautious there. But in reality, I think I'm just going to keep accumulating. Right? If prices get back to my levels, especially for some altcoins, just going to keep buying. Right? Just keep buying, because that's just a proven strategy, and it's been proven by time. Just look at like Palantir. If you just buy the weakness on a setup that's getting more and more bullish over time, it'll pay off. Same with XRP. I was doing that all the time below $1, like even below 50 cents. I was doing that, just kept on buying. Why not? Just keep building a position. And then when it explodes, it pays off, right? I think time is your friend and you shouldn't really fight it. And right now, we're just buying time and not losing levels. And this is not any kind of formation of a bear market starting, but it could last for a while. This could last for many more months of just being so painful that people just give up and capitulate. But I think that's the opposite of what you should do, because this is time that if you do have an income, then you can just slowly buy more over time. And then when things explode, guess what? Your little small accumulations are going to just explode. And that's way better than just timing the market in and out.
But I'd rather spend time commenting on your posts and hating on you, though. That's what I
Well, you can hate all you want, but hating is not really a strategy, though. It's just you're letting emotion get in the way of actually making money and being emotional.
No, you said the word strategy, and I hate you more. So no, I'm just kidding.
Fair enough, but basically, the people that hate out there, I think they're the ones that are more short-sighted. And being short-sighted in this market, especially when we could have a very multi-year possibility, more of a rally coming because of all this new technology, I think you're doing yourself a disservice by just hating and going in and out of the market. Just buy the trend, stick with the trend. Time is your friend.
Yep. I think that pretty much wraps it up for today. So yeah, guys, it's been an amazing collaboration, and for everyone who has watched this, make sure to spread the word if you've enjoyed it, and if you would like to see more collaborations in the future with these guys, because they're amazing and they share constant value on a daily basis. So make sure to follow them as well. Yeah, thank you guys for coming by.
Yeah, thank you, Luca. Thank you, Kat.
Yeah, thanks, guys. Yeah, winter's coming. Wear more clothes, okay? It's gonna get cold. All right, guys. Take care.
All right, guys. All right, bye-bye.
Bye.